The federal government is now borrowing about $6 billion a day. This week, that number stopped being abstract. It showed up in the mortgage rate. It showed up in the price of Bitcoin. It showed up on your electric bill. And it showed up in what a new dryer costs. One move in the bond market touched all four. That's the thread running through this entire week, and I'm going to pull it all the way through. Before we start, everything here is general education, not financial advice. I'm a 20-year appliance technician, not your advisor. And nothing in this video is a recommendation to buy or sell anything. 6 segments, let's go. Start with Tuesday. The yield on the 30-year Treasury bond touched 5.33%, the highest level since 2007. 19 years. Most people hear bond yield and tune out. Don't. Here's why it matters. A Treasury bond is the government borrowing money from investors. The yield is what investors demand in return for lending it. When that number climbs, it doesn't just make government borrowing more expensive. It resets the price of borrowing for everyone underneath it. Mortgages, car loans, business loans, credit cards. 3 things pushed it up at once. First, inflation that hasn't fully come down. Energy prices are part of that picture, and oil finished the week up more than 5%. Second, the deficit. More borrowing means more bonds for sale. More supply, same pool of buyers, higher yield. That's not politics, that's an auction. Third, and this one's newer, the AI build-out. Companies financing data centers are issuing enormous amounts of corporate debt, and that debt competes with treasuries for the same investor money. Hold on to that one. It comes back in segment 4. Wednesday, the Treasury Department stepped in. It announced it was doubling the size of its long-dated bond buybacks, from $2 billion per operation to at least $4 billion, with plans for up to $38 billion in purchases over the quarter. A buyback is the government purchasing its own outstanding debt on the open market to support prices and push yields back down. It worked, for about a day. Yields dropped sharply Wednesday, then climbed right back Thursday, which tells you something. The bond market looked at the intervention and said, not enough. So what did all that do to your wallet? The 30-year fixed mortgage averaged 6.65% for the week. That's down 2 basis points, basically flat. 15-year, right around 5.95. That surprises people. Long bond at a 19-year high and the mortgage barely moves? The reason is that mortgage rates track the 10-year Treasury much more closely than the 30-year, because most people don't hold a mortgage for 30 years. They refinance, or they move. And the 10-year sat around 4.7%. There's a term for what happened this week: bear steepening. Long-term rates rise, short-term rates stay anchored. In practical terms, that means the pressure landed on long-dated borrowing, mortgages, long-term business debt, while the short end, the part that drives your credit card APR and your savings account rate, barely budged. Worth knowing, because if you've been waiting on a rate drop to refinance, this week didn't deliver one. And if you've got cash sitting in a checking account earning nothing, the short end didn't move either, which means the gap between what you're earning and what you could be earning is still sitting there. That one's on you to go shop. Wednesday, the Treasury reported that the national debt crossed $40 trillion for the first time. Let me put the speed in perspective, because the number itself is too big to feel. 38 trillion, October of last year. 39 trillion, March. 40 trillion, this week. $2 trillion in roughly 10 months. And it got here early. The Congressional Budget Office's baseline had this milestone landing in 2027. Of that 40 trillion, about 32.2 trillion is debt held by the public, real borrowing from investors, foreign governments, pension funds. The other 7.8 trillion is intragovernmental, money the government owes itself, mostly trust funds. Here's the number that changed the conversation. Interest payments on the debt now exceed what the country budgets for national defense. Now, I want to be careful here, and I want you to hold me to it. This is not a one-party story, and anybody selling it to you that way is selling you something. The gross debt has doubled in roughly 10 years and quadrupled in under 20 across administrations of both parties. The drivers are the ones every serious analyst names: tax policy on the revenue side, pandemic-era spending, defense, and the 2 largest line items in the entire federal budget: Social Security and Medicare. Layer higher interest rates on top of all that, and the interest cost starts compounding on itself. The Committee for a Responsible Federal Budget, which is nonpartisan, and which has spent years criticizing both parties, put it about as plainly as it can be put. $40 trillion of debt doesn't stay on a government ledger. It works its way out into the economy and into household pocketbooks. There's one more piece to this, and it connects directly to something I covered earlier this week. Part of the reason the milestone arrived ahead of schedule is a revenue hole. Back in February, the Supreme Court ruled 6-3 that the emergency powers statute the administration had used to impose a broad set of tariffs doesn't authorize tariffs at all. That invalidated those duties retroactively. Estimates of the refunds owed back to importers run in the $160 to $175 billion range, and more than 2,000 refund suits have been filed at the Court of International Trade. A replacement authority was invoked. In May, the trade court ruled against that one too. So a chunk of tariff revenue that was in the budget math partly isn't there. And the administration has been working through older, narrower statutes to rebuild it, which is exactly what the Canada action I covered yesterday is. That's the loop. Less revenue, more borrowing, more bonds for sale, higher yields, higher mortgage rates. It's not ideology, it's arithmetic. Now the loud one, and I mean that carefully. Tuesday, Bitcoin was trading around $64,000. It had been stuck in a range for about 6 weeks, and it was sitting more than 40% below its record high from last October. By Friday, it was near 77,000, up more than 23% on the week, its best week in 2 years. So what happened? 2 things, in order, and the order is the whole story. First, the macro. Remember that Treasury buyback from segment 1? When yields dropped Wednesday, the dollar weakened, and risk assets caught a bid. Bitcoin pushed above 69,000, a ceiling that had capped it for weeks, and cleared its 200-day moving average on the way through. Then the mechanism took over. A short squeeze. Let me explain that properly, because the term gets thrown around loosely. A short position is a bet that the price goes down. You borrow the asset, sell it, and plan to buy it back cheaper later. If the price goes up instead, your loss grows, and eventually you're forced to buy it back to close out. That forced buying pushes the price higher, which forces more shorts to close, which pushes it higher again. It feeds on itself. And this one was historic. Wednesday alone was the largest short liquidation event in crypto records going back to 2021. Across 2 days, more than $4 billion in bearish positions were wiped out. Ether got squeezed even harder than Bitcoin did. There were 2 policy signals in the same window. The SEC published its crypto asset regulation proposal. I covered that one separately, and the key thing to hold on to is that it is a proposal, in a public comment period, not a rule. And separately, the White House hosted a meeting with crypto exchange and market infrastructure executives, along with a public call for Congress to pass a market structure bill. Now here's the part most of the coverage skipped. A short squeeze tells you about positioning, who was betting which way. It does not tell you about demand. All it proves is that the bearish trade was crowded. The thing that would make a move like this durable is real buying, and there was some. US spot Bitcoin ETFs pulled in roughly $1.6 billion Monday through Thursday, strongest week of the year. About $600 million on Thursday alone. But the analysts are genuinely split. Some think the bottom is in. Others expect one more flush lower before anything sustained. And Bitcoin is still roughly 40% under its October record. I'm not telling you what to do with any of that. I'm telling you how to read it. When you see a 20% move in 3 days, the first question isn't, how high does this go? It's, who was forced to buy, and are they done? This is the segment I'd pin if you only watch one. 2 AI infrastructure stories broke this week that I covered as they landed. Monday, NVIDIA disclosed in a securities filing that it could provide up to $105 billion in credit support and residual value guarantees for an 8-gigawatt data center campus in Ohio. 4.25 gigawatts initially, with an option for another 3.75. It's being built by an energy developer for OpenAI, with first compute expected online in 2028. Wednesday, Marvell granted Google a warrant to purchase up to $12.2 billion of its shares, tied to a custom AI chip agreement that runs through fiscal 2033. Big numbers, abstract numbers. Here's the one I did not cover, and it's the one that reaches your house. Tuesday, Pennsylvania's governor signed an executive order setting new requirements for data centers over 25 megawatts. Developers now have to address new or incremental power generation, cover the cost of transmission upgrades, and get local zoning approval before they can receive state environmental permits. The order's own title says the point out loud. It's about protecting consumers from data center impacts. So why does a zoning and permits order in one state matter to you? Because it's about who pays for the grid. Under most rate structures, the cost of new generating capacity and transmission upgrades gets recovered from everybody on the system, not just the customer who created the need for it. So when a very large new load connects, the infrastructure built to serve it can end up spread across every bill in the region, including yours. And the numbers there are real. In the PJM grid region, which covers 13 states, the capacity price went from about $29 per megawatt day to about $270 in a single auction cycle. PJM's own independent market monitor attributed roughly 63% of that increase to data centers, about $9.3 billion recovered from customers in one delivery year. Federal regulators later imposed a price cap. Nationally, residential electricity has moved from about 12.8 cents per kilowatt hour in 2020 to around 17.4 cents earlier this year, more than a 36% increase. The federal energy forecast has it near 19 cents by late 2027. Now, the other side, and I'm not going to skip it. Data centers are not the whole story, not close. Aging infrastructure, natural gas prices, storm and wildfire hardening, and a real surge in distribution spending are all sitting in that number, and researchers genuinely disagree about how the blame splits. One state policy lab looked at the same question and concluded data centers mostly are not driving residential bills yet. A recent utility industry research paper complicated it further. And be careful with the viral numbers. A widely shared claim that bills near data centers had risen 267% got fact-checked. That figure was wholesale power prices, not residential bills. Not the same thing at all. Here's my lane on this. I don't need to win the argument about blame. I care that your appliances run on that meter. When the rate per kilowatt hour climbs, the running cost of every machine in your house climbs with it, and that quietly changes the math on whether an old, inefficient unit is worth keeping. And remember segment 1? The corporate debt financing this build-out is competing with treasuries for the same investors. That's part of why yields rose. The data center and your mortgage rate are on the same wire. Which brings me to the part I actually do for a living. Appliances are caught up in the tariff machinery, and most people have no idea how. Under Section 232, that's the Metals Authority, which is a completely separate statute from the emergency powers tariffs the Supreme Court struck down. Refrigerators, freezers, dryers, washers, dishwashers, stoves, ranges, ovens, and disposals are all treated as derivative products, meaning they're covered because of the steel, aluminum, and copper inside them. Originally, the duty applied only to the value of the metal content. A proclamation in April changed that. For products substantially made of those metals, the tariff now applies to the full customs value of the item. That is a much bigger number, and it's still expanding. The Commerce Department's Bureau of Industry and Security has proposed adding another batch of derivative categories, and the public comment window on that proposal closes August 27th. If you run a shop, a parts business, or you import anything with metal in it, that's a live deadline, and public comment is open to anybody. What it's already done to prices. Major appliance prices jumped 4.3% in a single month back in May, according to Bureau of Labor Statistics data. 1 month. The broader index moved 0.5% in the same stretch. Here's the technician's read, and this is the save money part. When new units get more expensive, the repair versus replace line moves. A repair that didn't pencil out 2 years ago might pencil out now. Not because the repair got cheaper, but because the replacement got more expensive. 3 things I'd actually do. First, before you buy anything, ask where the unit was manufactured. Tariff exposure varies a lot by origin, and by how much metal is in the build. Sales staff usually don't volunteer that. Ask anyway. Second, get a real diagnosis before you replace. An enormous amount of what gets called dead is a control board, an igniter, a thermal fuse, or a drain pump. Those are $100 range parts sitting inside machines that cost well over $1,000 to replace. Third, check parts availability before you commit to a brand, not after. A machine you can't get parts for is a disposable machine, and disposable machines are the most expensive kind you can own. One correction on something you'll see floating around. Canada's retaliation does target appliances, along with dairy, steel, ag equipment, and electronics, starting September 8th. But be clear about the direction. That's a Canadian tariff on American-made goods. Canadian buyers pay it, not you. What it affects on this side of the border is export volume for U.S. manufacturers, and that shows up later, in model availability and parts pricing, not in this week's shelf price. Short list of what actually matters next week. The big one, the Jackson Hole Economic Symposium runs Wednesday through Friday. It's the annual gathering the Kansas City Fed hosts in Wyoming, and the Fed Chair's Friday keynote has been used to signal policy turns for 4 decades. 2 things make this one different. It's the new chair's first Jackson Hole address since taking office back in May. And under this chair, the Fed has stopped telegraphing its intentions ahead of meetings, which means a major speech actually carries information now, instead of just confirming what everybody already priced in. The printed theme is financial innovation and payments. That's the academic program. What every trading desk is actually watching for is a September signal, and the context going in is hawkish, not dovish. The minutes from the July meeting came out this week, and the committee voted 9-3 to hold rates steady, with the 3 dissenters wanting a hike. Not a cut, a hike. That's the first time 3 policymakers have broken ranks in the same direction in about a decade. Also on deck, personal income and spending, with the PCE inflation reading on Wednesday. NVIDIA reports the same day, which is the cleanest single read anybody gets on whether AI infrastructure spending is still accelerating, and that feeds right back into the bond story from segment 1. And that tariff comment deadline lands Thursday. So here's the thread. One move in the long end of the bond market, driven by a deficit that just crossed $40 trillion, and by corporate debt raised to build AI data centers, touched the mortgage rate, the crypto chart, the electric bill, and the price of a new appliance. Same wire, 4 outlets. That's what I try to do here. Not tell you what to think about any of it, just show you where the wire runs, so you can see it coming before it reaches your house. If that was worth your time, drop a like on it. That's the signal that puts this in front of somebody else standing over a dead washer running the same math. And subscribe if you want next week's, because I'll be right back here doing it again.